Hi, this is Professor Hazara again, and this is the third video on the on Module 1 of Advanced Accounting, which is investments. This video, we're going to continue with held-to-maturity investments, and I think we've covered most of the stuff. This is going to be a video dedicated to held-to-maturity bonds using a discount bond. Okay, and just to recall, in the last video, we had gone over the rules for pricing bonds, and we went over all the elements here, there, all these 5 elements of bonds here, and the pricing rules. We used a premium bond in the first example. I'll point it out in a second again, just to recall this. And in that case, the yield rate was less than nominal rate, so the price of the bond was greater than the face value, and so we had a decreasing in the amortization table. We had a decreasing carrying value. Now, this is going to be the same type of example. This example will be a lot shorter because I'm going to use the same example but change the yield rate a little bit, so we get a discount bond, and we'll just go through that. Now, it's a little repetitive, but it's an important topic, but also it serves as a good way to form a basis for available for sale instruments as we get into those. Those are a little bit harder because we have to consider market data in those. Okay, so anyway, so let's just go ahead and I'll start the video here, start the process here. Okay, so remember that if your yield rate is high, that means if it's greater than nominal rate, that means that you are a bad credit risk, because the worse your credit, the greater the interest rate the market is going to charge you. That's just logical. Think of a credit card. And in that case, the price of the bond will be less than the face value. So you will lend. You're doing the lending here. You will lend the other company less money than you will get back. And that's why, as you remember from 302, we call this a discount bond. Okay, now remember that we had done an example of a premium bond. And the premium bond example, by the way, you can ignore this. That's part of an older worksheet. The premium bond example, we had face value of 100,000, 5-year term, nominal rate of 10%, yield rate of 8%, and when the yield rate is less than nominal rate, that means you'll have a premium bond, and it means that your carrying value right there will be greater. Initial carrying value will be, or your initial price, the price, which is 107,985, that will be less than your face value of 100,000, or excuse me, what am I saying? It'll be greater than your face value of 100,000. Price here was 107. The face value is 100. So in the amortization table, the carrying value worked down from a high carrying value down to the face value of 100,000. Now we come over here to held-to-maturity bonds for discount bonds, and it's the same circumstances. The only thing I've done here is I have made the yield rate higher than the nominal rate. So it's still 5 years, $100,000 face value, 10% nominal rate. The only thing I've changed is the yield rate. Okay, so now we'll go through the same steps. This should be quicker because I already built in, because you've already seen me build this stuff in, all the accounts and stuff, but I've got all the accounts right there. Okay, so let's go ahead and build a price. Okay, we know that the nominal rate will be used to determine the cash flows. The discount factor, the yield rate will be used to compute the discount factor. And the price of the bond will be added up right there and will become the initial carrying value for the bond. So let's go ahead and get started. The cash flow is going to be, once again, as you can guess, 10,000, because nothing's changed in this example except the yield rate. Everything else is the same. Okay, so we're going to take 100,000 times 10%. That'll give us the same annual cash flow inflow of $10,000. Now I'm going to freeze those cells again. Let's go ahead and freeze up those cells right here. And we'll copy those down. So far, nothing's changed. And we'll recognize once again that in the year 5, you're going to get both the interest payment and you will also get the face value. Okay, now for the discount factors. We're going to use the same formula, but now we're going to have a discount rate of 12%. Okay, so here are the factors. Just like this is exactly like in the previous example. It's going to be 1 divided by divided by 1 plus the yield rate of 0.12, and every one of these will be raised to whatever time period you're going to receive it. You're going to receive it after 1 year, we'll raise it to 1. You're going to receive it after 2 years, we'll raise it to 2. Then we'll raise it to 3 for 3, et cetera, et cetera, et cetera. So we'll raise this to 1 year. Okay, so our discount factor is about 90% for 1 year, discounting $10,000 for 1 year at 12%. And that makes sense because it's going to be less than the previous example because we're in the denominator, you're using 12% rather than 8%. So it's a smaller number. Okay, so the only thing we've got to do then is copy down, go ahead and freeze the interest rate, which is the 12%. We're freezing the 12% with those dollars. And then we can just copy down. And that looks good. We can just copy that down. That looks pretty good. Okay, as with my numbers. Okay, and so 10,000. The first $10,000 payment going 1 year out has a present value of $89.28, and then we'll just go ahead and get all the present values. And it does look, the numbers do look low. If you recall from the last example, these do look low compared to the other example, which means that you're going to get a low price for the bond. So the low price for the bond is, it is a discount bond because the price of the bond, which is $92,000, is less than the fair value, what I'm saying, the face value of the bond, which is $100,000. Okay, so let's go ahead and go finish our amortization table. The amortization table, the mechanics are exactly the same as in the previous example. The only thing that differs is that you're working up towards the face value rather than down. Okay, so let's go ahead and start. As always, the initial carrying value of the bond at time period 0 will be the price. Okay, then, let's check the sound here. Yeah, sound looks good. Okay, so the initial carrying value is the price. The mechanics are all the same. The wait here. Okay. The interest revenue is going to be the previous period's carrying value times the yield rate of 12%. Let's wait till that gets through. Okay. And we're going to be copying down again, and the number I'm going to want to freeze is 12% because every one of the interest rate numbers is going to be the previous year's carrying number times 12%. Okay, then we come over here to cash, and I'll just go ahead and you can do, you know what it's going to be. I'll just use the original numbers again, but we'll just take 100,000 times 10%, and the cash that you receive doesn't change. That stays the same. Okay, and we'll freeze up both numbers. Okay, so we'll put dollar signs in front of both numbers. Now here's the interesting part, is the mechanics are exactly the same to get the change in the carrying value. To get the change in the carrying value, I'm just going to take the interest revenue minus the cash, and you'll notice that this gives me, in this case, a positive carrying value. Okay, and that makes sense because we're going to be adding numbers to this 92,000 to work up to get 100,000. So we'll be adding two positive numbers. So my new carrying value is the 92,000 plus the change in the carrying value gives me 93,000. Okay, now let's go ahead and see if we can just copy these down. I think I've frozen everything I need to freeze. And we'll go ahead and copy these down and see if I get 100,000. Yes, I get 100,000. So that means if I get 100,000 there, that means that my table's got to be correct. I've never seen a situation where the table's not correct. So all we need to do now is fill in the journal entries and then post those journal entries, and the balance sheet should come in. But the only difference here is going to be in that in the previous example, my carrying value, this is an asset, recall, this is an asset. I had a premium. In this other example, this was a premium, so I was reducing an asset with credits. in this example, I'm going to start with a low asset, and I'm going to increase the asset with debits. Okay, so let's go to the first journal entry. And the first journal entry is going to be you actually lend the money out. So you lend the money out. That's equal to the price of the bond. And you might think it's not fair, but in this case, you're going to get back $100,000. You're going to get back the same cash flow that you did last time. $50,000 in interest and $100,000 at the end. You're going to get back $150,000, but you're only going to lend this company $92,000. So you may think it's not fair, but the fact is it's probably a bad credit risk. Okay, so at t is equal to 0, we have a debit to the held maturity account of $92,000, and that's what you would show on your balance sheet. But this balance sheet is as of time is equal to 1, so we'll let that go here. Okay, then we come down next. Okay, now I'm just going to point this out here. Although the t is equal to 1, this is true for all this. Although t is equal to 1 is sort of on the credit side here, just to give myself some space. I put them over there, but the entries are going to be on the debit side. So let's say that we come over here, time period 1, and we're going to be pulling time period 1 numbers from the amortization table, and they're going to be from the year 1 line, obviously. Okay, so our interest revenue is going to be a credit for $11,000. That's a lot more revenue than we had last time, if you recall. Those were under $10,000. Okay, then our cash is going to be equal to $10,000. And now we're going to debit the held to maturity investment account because we're working from $92,000 original carrying value up to $100,000. So all these are debits to the asset account. You're increasing them. Okay, so there's your new carrying value should be as follows. You have a debit here for $11,3045. If you add the original carrying value of $92,790, it's equal to $92,790 plus $11,3045. Your new carrying value is $93,925.30, which is equal to that first year carrying value of $93,925.30, and that is the number that goes over to the balance sheet. I've got it fixed, so this all works in, obviously. Okay, then the rest of this is very, very repetitive. Then we come down to interest revenue. Interest revenue for year 2 is $11,271. Our cash, cash is going to be the same because you get the same amount of cash every year. And then the debit to the asset account is $11,271. That debit will be posted. I'll go ahead and copy this down. This is an entry at t is equal to 2. So that debit will be posted right there. And so the new balance at t is equal to 2 is $93,925 plus $12.71. That gives you $95,196, which is also what's going to show up on your balance sheet right there. Then we're going to come down to year 3. Year 3 cash is $10,000. Year 3 cash is $10,000. The interest revenue for year 3 is this is 11, just to show you. It's 11,42356, and the held to maturity account is going to be a debit again because you're increasing the asset. The carrying value should be increasing. 1423.56. Okay, so we'll post that for year 3. For time is equal to 3, we'll go ahead and post that 1423.56. So your new carrying value is $96,619.90, which will show up on your balance sheet right there. It's right there. They didn't line up. There's nothing I can do about that. So that your t is equal to 3 balance sheet is $96,619.90. That's the same balance as in your t account, and it should also equal the balance carrying value for year 3 on your amortization table, which it does. Okay, we're just about ready to finish this example. Okay, it is held to maturity. Okay, year 4, the revenue for year 4, the interest revenue for year 4 is 11,594 something. Cash will always be 10,000. I might as well be official about it and point it there. And then the change in the carrying value is going to be 1594.39. Okay, and then, and I'm just putting these arrows here. I'm just putting these arrows as a way of saying this is when this entry was made. So this entry was made. I just don't have time. There's just to seem the space a little tight there. So this last entry is a debit for 1594.39, and our new carrying value is 96,619 plus 1594 gives you 1398,214, which I always like to check carrying value, which is 98,214.29. And then finally, the final entry almost is the cash that you get in year 5 is 10,000. Your interest revenue is 11,785, and the debit to your held to maturity account is going to be 1785.51. Okay, so if I take if we make that debit, you should end up with a final carrying value of 100,000. Okay, so your T equal to 4 balance was 98,214. We're going to add to that your final debit of gotta wait for this thing to catch up here. There's a lot of stuff on this computer. So it's going to be, the debit is going to be 1785.71. You get 100,000. And the last part of this, I'm going to do this fast, is you've got a balance in here of 100,000, which means that somebody owes you 100,000, so they got to pay you 100,000. So the final thing is you've got to collect your 100,000. You'd be amiss if you didn't. So you're going to end up with $100,000 in cash, and there's going to be a final credit at t is equal to 5 for 100,000, which is, oh, whoops, forgot to make the entry. This credit is equal to that $100,000 cash that you got. And then finally, t is equal to 5. I just want to make sure it comes in here. It's equal to 100,000. So your final balance here is this debt balance for 100,000 minus that credit balance. Entry for 100,000. Your final balance is 0. Don't forget to make that last entry because it's kind of important to collect your money. Okay, anyway, so that was repetitive, but both these examples should give you a pretty good idea of how held to maturity accounting is done. It's simply two things. It's like bonds payable, but it's reversed. It's not bonds payable. It's, in a sense, bonds receivable. We call it investment in bonds. And the other thing is we don't use a separate premium or discount account to record premium or discount. We just bury the premium and discount right in the held to maturity account, and you could see that right there. I mean, you know, you had a discount of 100,000 less 93, about $7,210. Same thing held true for the premium. Anyway, so this concludes these lectures on the easiest type of investment accounting, which is for bonds. We're going to start available for sale. That's the second category of investments. And that's going to be the one that could be, it's not terribly difficult, but a little tricky. Anyway, so I'll post this, and then I'm going to do 1 or 2 available for sale examples. You can see already here that I'm extending both examples out here. Anyway, so everybody stay well, and I will post this up on YouTube. Thank you very much.